Welcome to this Killick Explains video on tax saving basics part 1, and there are 4 videos in total. This is the first one, and this one is all about what is an ISA. So investing tax efficiently arguably has never been so important. We all know that living costs are rising at the moment. Inflation is back. As I make this video in early 2023, there are some signs it may be reducing, but it's still pretty high. And then of course you've got the autumn statement from 2022, which is going to do a number of things which will take effect in 2023. The personal allowance for income tax is being frozen, and I'll give you a guide at the end that will help you out with some of this stuff. The dividend allowance, that's the amount of dividend income you can earn, tax-free, is being reduced gradually, and the capital gains tax allowance is also being reduced over time. On top of that, economic uncertainty abounds. Now, some people would say, and therefore I'm going to turn off my tax effective saving because I need to conserve cash, but that's a mistake. This is the time, with reductions coming in from the autumn statement and challenges left, right and centre, this is the time to try and keep up those tax effective saving routes if you can. So which taxes are we talking about here? Most of the solutions I talk about in this mini-series are all about reducing a combination of income tax, that's the tax we pay on things like salary, earnings, dividends, interest and so on. Capital gains tax, that's the tax on making profits on chargeable assets, shares, property and the like. And inheritance tax, which attaches to what's called a death estate. So, where do individual savings accounts or ISAs fit in? Well, here's a quick potted summary, more information available at the end. So this is a tax wrapper. All it is a shelter to protect whatever's underneath it from income tax and capital gains tax primarily. And you can shelter a lot. Up to £20,000 per tax year can be invested into an ISA. It can be done as a lump sum. It can be drip fed in on, say, a monthly basis to take advantage of what's called pound cost averaging. There's a massive choice of things that can be within this shelter: cash, shares, bonds, funds, and so on. And the win is once the wrapper is around those investments or around that cash, there's no income tax and there's no capital gains tax, no matter what happens next. What's more, you can transfer funds under the wrapper from one provider to another if you're not happy with the performance you're getting, for example, and that can be done at any time in the future. And withdrawals are permitted, but you need to be careful for reasons I'll come back to in just a moment. Now, a few twists, because what I've given you there is the basics. So what are the twists, things to watch out for? Number 1, these are use it or lose it products. You've got until the 5th of April to basically decide, am I going to use my ISA allowance or am I going to forego it? And there's no catch-up with an ISA. Existing investments can be part of what you transfer into this shelter. There is a thing called a bed and ISA arrangement, for example, where you sell investments you currently hold outside of an ISA and buy them back within an ISA. Now, there are 1 or 2 risks attached to doing that, so it's worth having a conversation about it, but nonetheless it opens up the possibility of existing investments becoming part of an ISA, not just necessarily new ones. Okay? You can keep cash within an ISA, so if you're not sure what you want to invest in, you can load up the ISA with cash and then commit it. Holding a lot of cash within a tax wrapper doesn't make a huge amount of sense in some respects because there are potentially better inflation-beating returns elsewhere, but nonetheless you can still lock and load it. And be careful with withdrawals. Yes, you can pull money out of an ISA, but if you don't reinvest it into the shelter within the same tax year, you potentially lose all future tax efficiency on that capital. And finally, watch out, because ISAs are technically part of the assets you leave behind on death for inheritance tax purposes, albeit the other tax benefits, income tax for example, can be protected if one partner dies via something called an additional permitted subscription, which I cover in more detail elsewhere. So what are the takeaways from this short revision video on ISAs if you like. They're a no-brainer in many ways for many people. Do check therefore how much of your ISA allowance for the current year you've used up and how much is left up to the ceiling. Understand what's under the bonnet given the wide choice available in terms of cash, shares, funds and so on, and do weigh up periodically the performance you're getting versus the fees that you're being charged. So, lots of detail not covered there. For more information, several places you could go. One is my comprehensive video library, killick.com/learn, and the other one is a tax effective saving guide with a light blue cover. It looks like this, but different colour on the cover, and that would be editor@killick.com.